So just a little bit about myself to give more information. As you said, more than 30 years in the dry bulk shipping with various companies that he mentioned. But most importantly, the last 5 years in Torvald Clavenes, I was also the head of digital transformation. That was the first time I realized how the FFAs are so critical in terms of understanding the results that you are generating in your own business. Because people don't tie up technology and FFAs that quickly all the time. So I'll talk a little bit about that as well. As I said, I'm from the Bayes Business School and of course, a law degree as well. The good part about the experience that I've had is that it's been very varied in that sense that I've worked with a shipbroker, I've worked with an operator sitting in Dubai, I've worked with a ship owner, pool manager, and a commodity house like Noble. And I would say Noble and Torvald Clavenes, I had the most experience in trading as well as managing FFA exposure because I had P&L responsibilities that I needed to execute, and FFAs were a very important part of that discussion. What am I doing right now? I've moved out of the corporate space and looked at mostly teaching and also investing in maritime startups. One of the startups that I'm mentoring is right here, Tatya. We'll talk a bit about that as well. But I'm actually involved in consulting and teaching a lot. And that has nothing to do with FFAs. It's actually a course that I teach in various universities globally on geopolitical risks and impact on trade flows. So if any of you wants to actually attend a lecture of mine in SMU, please do let me know, connect with me on LinkedIn. I'll be happy to connect you with SMU and see if you can come along as a guest for my lectures. Maritime NXT is about teaching, training, and technology. So teaching is predominantly university-centric. Training is more industry training. So I'm involved with BIMCO as a trainer with Institute of Chartered Shipbrokers. And obviously, I'm involved in technology through startups. I'm also an investor in Motion Ventures, which is a VC investing in maritime startups as well. So obviously, I'm in a different space now compared to the corporate space. But as I asked Kenneth about, what is the logic behind me giving a workshop like this? I think one of the logics is that having come out of the corporate space, I understand the pain points involved with FFAs. Being a teacher, I understand a lot about how the theoretical concept works as well, because I teach it every year to students. And most importantly, all of you guys are probably very good in what you do, specifically in your own areas, sectors, desks, whatever. I get a chance to kind of take a step back and look at the bigger picture, a holistic picture. So maybe my presentation today will actually give you some perspectives, which are probably ideas lying right next to you in your desk, but you don't have the time or the ability to look at them in such intricacy and detail, which I hopefully will share. The idea is to basically take away things from this which can practically help all of you, right? So what's the learning scope? This is a workshop on risk management. So before we come to the FFAs as a way of managing risk, I will talk about risks in general in shipping, and there are 4 of them. I'll talk a little bit about operational risks and how people manage them in the traditional way and sometimes in a more technology savvy way. Regulatory risks, and of course geopolitical, because I'm obviously involved heavily in that space now. But finally, I'll talk about market risks, and that's where the FFAs fit in quite nicely. So I'll spend some time talking about the risks so you get a context, a perspective as to what we are trying to set here narrative-wise. And then we dive into the FFAs itself, and we talk about what is an FFA, how does it work. So we'll talk about defining the FFAs, how to hedge your exposure, what to hedge in terms of your exposure, and who are the key players and how do those processes work. I mean, I really want you guys to go away with some key lessons here which you will actually be able to implement in your job, either today, tomorrow, whenever. The idea is to make it a lot more practical. And finally, I'll try and see from my own experience and probably mistakes mostly over the years as to how we can look at the do's and don'ts of the FFAs. FFAs are not perfect. They work in some cases, they don't work in some cases. So you have to be very clear that you understand. Risks are not something that you should be worried about as long as you're taking them with the knowledge that it is a risk to be taken. That is very important to understand, right? And of course, I will talk a little bit about technology. In the last 5 years, my interaction with technology has been really refreshing. A lot of new perspectives, a lot of new ideas. You know, founders of startups are very young, energetic people. They look at things from a very different perspective. So I'll talk a little bit about that space as well, and see how you can actually benefit from that. Right. So let's start with operational risks. And by the way, if any one of you wants to ask a question in the middle of the presentation, please feel free to do that. I can make it as interactive as possible. And obviously, you can keep the questions flowing wherever and whenever possible. So the first operational risk is the ship itself, the equipment on board the ship. Managing that, according to me, is very much to do with training, teaching, upgrading the people itself, plus also maintenance of the equipment that needs to be done. So that's kind of a, over the years, it's been perfected, or at least got a lot more interesting to talk about that. There are not that many new areas to discuss that. Of course, there are technology advancements which are coming all the time. The second thing where a lot of people are investing is in the routing of the ship. Operationally, where do you route your ship? Not just from a perspective of saving money, but also avoiding risks. And this is, again, it could be weather-related risk, it could be a lot of other risks, whether piracy, etc. Obviously, you have those routing discussions as a big part of your operational risk discussions that happen in your office. And finally, you've got navigational hazards. You know, this is something which is obviously a big part of the overall discussion now. How do the seafarers get upgraded in terms of using technology on board? Navigational hazards are also a part of the discussion of inability to use these things smartly and efficiently, right? So you still have those challenges, but again, a lot of this is to do with technology and training, and that's perfectly fine. And that, again, is something that FFAs can never help you with. So don't worry about this. This is not something that you can solve with FFAs at all. Right. Regulatory risk, on the other hand, has got, and we had an amazing discussion with the Baltic panel earlier on decarbonization, EU ETS, fuel EU maritime, and the IMO regulations. IMO regulations are very challenging purely because they are global in nature. When it comes to complications, you can have local regulations which are complicated, but they have a limited domain of expertise or areas to look at. IMO is literally a global space. So anything that actually impacts everywhere, anywhere in the world will have a bigger impact in your day-to-day operations for sure. Flag state regulations. When you look at your own ship, and this became a big issue when the Baltimore bridge collapsed because of the ship hitting it. Immediately, the Straits Times were putting out explainers saying, what does it mean to be flagged in Singapore, right? What does Singapore flag mean? And what kind of regulations are impacted with regard to your own flag? So you may actually feel that you have no problems where you're based in your country, but your ship is flagged in a country where there may be specific regulations to follow. So there is a regulatory risk because after this incident, I'm sure MPA will come up with some changes to their regulations in terms of how it's managed. That is going to be a regulatory risk, whether you like it or not. And finally, specific ports have got specific regulations that they look at. And this is something which is very important that it's updated. This one can only be resolved by two things. It can be resolved by updated information, awareness, and secondly, some kind of action, whether it is question on board or onshore. But it's not, again, something that FFAs need to deal with. So let's look at the third type of risk that we are looking at, which is the geopolitical risks. And I have not captioned these titles or these pictures because I really want to try and talk to you without thinking a perspective as to what it actually means. So what is this according to you? Anybody can point this out? It's pretty clear, right? It's trade barriers. So barriers to trade and free trade agreements are one of the biggest geopolitical risks and benefits and opportunities that exist in this world. Today, trade flows change because of Trump putting tariffs on Chinese imports and vice versa, right? So trade barriers change trade flows all the time. That's a huge risk because if you're based your business on a particular trade, and that changes because of a trade barrier, suddenly your business plan goes haywire. The second geopolitical risk is what's happening in the Red Sea. Critical pathways. Suez Canal, Panama Canal, Malacca Straits, Straits of Hormuz. These are all critical pathways. They all are geopolitically sensitive areas. And they create one of the biggest challenges when it comes to the risks and trades that you actually have to work with. Again, can you work with FFAs on that? I'll come back to that towards the end of the presentation. You can, but you have to be very careful and calculated in your approach. Third is demographics. Demographics is the hidden change happening geopolitically in the world. It is basically changing people's price or income, it's changing people's preferences, and it's changing people's demand scenarios, which means that trades which never existed before are now actually moving along because people are getting exposure to certain tastes, certain preferences, certain goods, and they want it. And that's really changing the way trade flows as well. You have to keep yourself on top of that. FFAs can't help you there again. Economic dominance of countries. This is the dragon, and it's pretty much captured the world. And I'll show you to you in a very small graphic right after this, this presentation here. It's very interesting that the dominance of one country having tremendous amount of economic aid and debt with the rest of the world has created trade flows which should not have otherwise existed, only because of the economic dominance of the Chinese scenario. New alliances. This is the BRICS Plus alliance. BRICS, as we know, is the Brazil, Russia, India, China, South Africa. The BRICS Plus is expanded to many more countries, including Iran and Saudi Arabia. How they're going to get along, we don't know. But at the end of the day, trade is flowing because of that. Alliances are creating new trades all the time. And finally, technology. When I was in Clavenes, there was never a trade till 2010 of any commodity called spodumene. Spodumene did not exist as a trade. Because lithium batteries became a hot property, electric batteries became hot property, spodumene started being exported from Australia. Today, companies have got pretty much 65% of their export COAs in spodumene from Australia. There are companies who are based there who do that. So again, these are geopolitical risks. Some of them can be hedged with FFAs. Some of them can be hedged, but not all of them. And I'll just end the geopolitical thing with just one slide that I show my students right at the very beginning of my lectures. That's the changing colors of the world trade. This is the world in year 2000. In year 2000, this is from Financial Times. Year 2000, you can see pretty much the entire world was blue in majority countries. And that means that the biggest supplier of that country, physical supplier of goods, was America. The red countries were in China. In 2018, in 18 years' time, this happened. This is basically happening even today. This has not changed massively since 2018. It's still there. What I'm trying to say here is that somebody sitting in Argentina used to pretty much get his goods from close by America. Today, he's dependent on China as a principal source of supply. This is what has changed. And you can't hedge it unless and until you know it and you try and work around it with customers, stakeholders, and potential technology changes and technology solutions as well. I'll come to that. But this is not the lecture. If you want to look at geopolitics and trade, very interesting subject, come to SMU and listen to me when I do it once a year. Right. Market risk is what we are talking about here, and that's what the rest of the workshop is all about. So this is a Cape size 5TC market for the last 5 years or 4.5 years. And you can see that the volatility has been simply unbelievable. But when you look at the lowest point in the last 4.5 years and the highest point in the last 4.5 years, that gives you the extent of the volatility we are talking about. So this is the lowest in Feb 2020, 2274. Highest, 74,176. In any market, you cannot imagine this kind of volatility will not create challenges for you. They do create challenges. And that is why One of the options is FFAs, and there are other options, of course, existing as well. But market risks is one of the biggest challenges that any company faces, irrespective of whether it's a shipping company or a non-shipping company. Market risk is the biggest challenge. But in our case, it's a very direct impact. What do we do with that? So we have two ways of managing market risks. The first is the conventional method, which is a physical hedge. You have a ship, you are worried about the market going down, you just fix it away. You have a lot of Japanese trading houses doing that all the time. They basically build ships with an intention to give it away for 10 years, and then they sell off the ship or trade it for another 10 years, whatever the case may be. But they're not really looking to keep it in the spot market because they don't want to take the risk of the volatility, which I just showed you, from 2000 to 74 and back down again, right? The second option is a financial hedge, which is what we are talking about. A financial hedge, at the end of the day, is an alternative to physical hedge, but not really. It's actually the third option, which is the smart one, which is the optimal blend of both. You can't depend just on FFAs alone. And I repeat this again, although this is a workshop on mastering FFAs, one of the things that you need to understand is great to master FFAs, but please understand FFAs are not a short solution for every problem. They are one of the solutions that you can get. But physical hedges are still very useful when you have the right ability to turn them around. But FFAs have what is called a flexible way of hedging your positions. And I'll come to that in a minute. Right. So these are the key risks that we've covered, starting from operational, regulatory, geopolitical, and market risks. Right. So the risks are clear in your mind. Let's now get down to derivatives and FFAs. So before we come to FFAs, we have to understand what does a derivative mean in the first place. A derivative is nothing but a swap. A swap in our normal lingo would be that you give me something, I give you something. That's why we swap something. You know, I've got that the barter trade concept in our mind, you know. You give me something, I give something back. In some ways, it is like that, but it's a little bit more sophisticated than that. It's essentially two parties taking a bet on the price of the underlying commodity. Any commodity at the end of the day can only move in one direction at one point of time. At the end of the day, one party is taking a position that the price will go up, and the other party is basically taking a position that the price will go down. It's like I always ask my ex-boss in Precious, why people go into sale and purchase. It's the same ship, but somebody wants to sell it, somebody wants to buy it. The same ship, it'll trade in the same market. But that's because views on the market are very different, and that's exactly what it means. So what does it actually mean? The key thing about a swap or a derivative is that the underlying product must be standardized and homogeneous. You can't swap apples and pears and think that it's a good bargain. Maybe it's good for one guy, not for the other guy. It will always be a challenge to swap something that is not standardized and homogeneous. So underlying product must be standardized, must be homogeneous. Secondly, you must have an agreed quantity that you must swap. You can't just go and say, okay, let's do swap, but you don't know how much you're going to actually swap. What is the quantity involved at the end of the day? You also need to swap on the price agreement for a particular forward date. You can't say that I'm going to buy gold from you, but I don't know when I'm going to buy gold from you. I don't know what quantity I'm going to buy. And I don't know whether I'm going to buy a gold nugget or a gold bar. What am I actually going to buy? 22 carat, what actually is going to be the gold quality? So all these things need to be very clearly stated in most cases, in a swap especially. And finally, a price has to be agreed. The price is eventually the key exchange for financial gain and loss. So very simple example. What does this mean? An underlying product, let's say gold, you are basically saying, I'm going to buy 1 ounce of gold on whatever prevailing price at December 2024, and our agreed price is $1,000 per ounce. One will buy at 1,000 and one will sell at 1,000 for December 2024. Come December 2024, if the actual price is $1,500, one party will pay 500 to the other party. That's exactly how a swap works, with the underlying asset being either gold, oil, interest rates, and freight. It's a very simple transaction. There is no complications in terms of what you're getting into. You're getting into a pure agreement to basically take a position on an asset. In this case, the asset is freight. That's all you're taking a position on. Now, what is an FFA in this case? So FFAs is simply a swap on freight at the end of the day. Nothing else. It's just the concept of the swap. Replace gold with freight. And what is the underlying freight product? It is either a time charter rate, or in some cases, as SGX has explained, as Kenneth has explained, it can be an voyage rate as well, because you need some standardized rate at the end of the day to work with. So I will talk more about it, but at the end of the day, it's a freight that is the underlying asset that you're looking at. You must have an agreed quantity, you must have an agreed forward date, you must have an agreed price. Nothing changes that. The same elements from the last time as well. Also, it will result in financial gain and loss. You cannot buy an FFA and expect the other party to actually perform a contract physically. There'll be no physical performance under FFAs. So this is very important to understand. It's not, you may be hedged, but you can't ask the other party to give you a ship. It's not going to happen. That is not the idea. So there's no physical performance at all with regard to FFAs. It's a purely money transaction which is going to change hands. So there's going to be no change of any physical performance, right? So that's why FFAs are clear. But let's try and go deeper into these topics that we mentioned, the elements of agreed quantity, underlying product, forward date, price. What does all this mean in real life? You guys must be seeing this thing in your day jobs. You must be having these figures come out, market reports come out, Clarkson sending you something, Braemar sending you something. What's all this actually meaning in terms of the numbers? The key is FFAs also do not need you to charter any ships, because there's no physical performance. You can actually enter FFA market in and out without really getting in the hassle of hiring a crew, hiring any bunkers, nothing like that. You don't need to worry about that. So that's what makes it very interesting for players. Now, what are the key motivations behind the FFAs? So there are three types of motivations that can be there. The first is you're a ship owner. If you actually have an asset which is now exposed in the market, your only biggest concern is downside. You're not really worried if the market goes up, right? You're just counting money in your bank. You're really worried about downside. So as a ship owner, FFAs are a motivation to hedge the downside. I want to make sure that the current levels are locked in, because I have a really fearful situation where the market might go down. On the other hand, if you're a cargo owner, you're worried about an upside. You think this market's going to go off even further up because of various combination of factors. So you're looking to hedge your freight in order to avoid the upside challenge. And then you have these people who have no fear. Fearless characters. These fearless characters are the market makers. They are the people who actually create the volatility, the volume, the liquidity, because they're willing to take positions in either a good or a bad market, because for them, every market is a good market. They love the idea that they can take positions because somebody is not reading the right signs, and their entire game is based on buy low, sell high. If you think it's low today, buy the market. If you think it's high today, sell the market. And this is, by the way, not just FFA principle. It is for every asset that you decide to buy. You do your home buying, you do exactly the same thing. So essentially, the motivation is very clear. The key thing is the last set of players, the market makers, really make the game change. And with the clearing houses, as I explained to you, you take away the counterparty risk as well. Because one of the biggest challenges is that this guy who's a market maker just decides to take a position because he's very smart. He thinks he's very smart, and eventually has to perform that and pay out the money. Does he have the money to pay out? Clearing houses make sure that he does have the ability to do it most of the time. Right. So, underlying product is the first thing we will talk about. The first criteria is the underlying product must be standardized, homogeneous. It should be regular, reliable, and trustworthy. Why do I say this? Because if the underlying product is not something that you trust, how can you do a swap? How will one party feel confident that this is good enough for him to swap with whatever he's swapping with? Then you have a problem already. High frequency of data is needed. You need continuous updates on the value of the product. You need the pricing data to come in more regularly. You need reliability, and that is where the Baltic Exchange comes in. The Baltic Exchange has been doing it for hundreds of years, and obviously they have several benchmarks which they are having as indices in various sectors of the shipping industry. The key thing is they also have standardized vessel descriptions. Something that I'm sorry to say, but in my 30 years in the shipping industry, I'm struggling to find a standard vessel description from a single owner, not differing from another owner's description. Some people describe their fuel consumption in long tons, some in metric tons. It's a big disaster. Unfortunately, we have no way of standardizing that. But the Baltic guys have done that for the indices, and that's useful. Then you have standardized route descriptions. What does that mean? They actually tell you that this particular index or route covers this particular trade. If it's a Pacific round voyage, where is the ballast point? What is the loading area? What is the discharging area? What is the duration? And how many days ahead of the laycan is this index number for? You know when you're going to fix your ship. That is what you actually have to start working on. So the route description, the cargo descriptions have been standardized by the Baltic. They spend a lot of time getting this thing done. So that actually makes them quite reliable and trustworthy in that sense. And finally, it's regular because it's published every working day. And thanks to the fact that we are doing it more in Asia, we get a lot of indices in Asian time zone, so you can actually start getting information in the afternoon so that you can start trading FFAs and other things during your daytime as well. Otherwise, I remember waking up at 2 o'clock in the morning to try and clear a trade up because of the fact that I've just fixed a ship at the same time. That's the kind of challenge that you had earlier on. Things are changing, but the regularity is very important. So regular, reliable, trustworthy, standardized, homogeneous underlying product. Baltic freight indices. That is what your eventual underlying product is. Now, let's come to the second part. This is what the indices look like in reality. In the dry side, I will not go into the other sectors, but dry side, you've got the Capes, Panamaxes, Supramaxes. They are doing a dual reporting between Supras, 58,000 deadweight and 63,000 deadweight, and handy size. You can get these cards from the Baltic Exchange or SGX. They can actually send them across to you, or they should be on the website as well. But this gives you the standard description of the ship on the top, and it gives you the individual route description as well. This is important, guys, because this will be the basis on which you trade your FFAs, the standardized descriptions. So what do they actually offer you as products in the Baltic indices? They give you an ability to buy or sell a basket of routes, which is the BDI, the dry index, the Cape size index, Panamax, Supramax, handy size index. They can also give you the ability to buy and sell individual routes, either across regions, Atlantic to Pacific, Pacific to Atlantic, or within the region. So depending on your exposure. They also give you the ability to buy tenures. You can buy a month, you can buy a quarter, you can buy a year. So they have the ability to look at that as well. And you can even buy part of a contract, which means that instead of buying 30 days in April, you may buy only 15 days of April, half a contract. That gives you the flexibility to sometimes say that I have a short voyage in this month. I don't want to buy the full month. I can buy half a month. And that is where it gets interesting. Remember, it's half of the full. The full is a standardized contract. So you're just buying 50% of your exposure, which is what your actual physical exposure looks like, right? So this is interesting to understand that these indices are standardized. And I'm trying to push more of this idea in your mind because a lot of the people don't understand why the Baltic comes out with these descriptions. Are they realistic, unrealistic? It doesn't matter. As long as the description has a particular type of standardization, the numbers that are being generated are always based on the same description. If there is a mistake being made, it is consistently being made in the same way, which means there's a pattern that you can go with, the trend you can go with, the differential that you can go with, right? Okay, now the quantity. So as I said, this comes from SGX. The quantity is minimum trade is 1 day per month or 1,000 tons of cargo. You can buy lots according to what you want in your own exposure. If you want to basically have a Cape size rate, the route says 160,000 tons, but your cargo size is only 120,000 tons, you buy 120,000 tons. So the agreed quantity is completely dependent on your physical exposure, which means you can match it to your physical exposure. This is something which is very important. You can buy lots according to your own physical exposure, which is a great way to hedge it. You're not forced to buy the whole contract, which is important to realize. And then, of course, what about the forward dates and prices? You know, you have the agreed forward date prices. That's another part of it. So these are two examples I'll give you that comes to you every day in your inbox. This, by the way, is available online. It's called bremarscreen.com. Bremarscreen.com is a website which Bremar maintains. And essentially, it's a great snapshot. I love the snapshot. It's got a tweet that's going on the side, but also you can see the products which are on offer. Cape size, months, nearby months, April, May, and then nearby quarters, second and third quarter, and the whole of Cal 25. Capes, Panamaxes, Supramaxes, the bunker prices, and then obviously some more latest data and information coming along. This comes to you on your screen sometimes. Sometimes you get it from the brokers in form of a report. This comes, for example, from Clarkson's Plateau. It comes on your email if you're really subscribing to this from the brokers. What does this mean? This only means that the additional element in this is there is a bid-offer spread. Bid means the price at which somebody is willing to buy. So BID and BUY, 3 letters each. Always remember, BID is buy. And offer is the price at which somebody is willing to sell. At the end of the day, the bid-offer spread is what is there in every commodity. If you buy foreign exchange, you still have the same thing. You go to the airport and you actually go and buy Thai baht, it'll actually have this we sell at, this we buy at. It's exactly the same thing. It's a bid-offer spread. This comes to you pretty much every day, and you can see the nearby months, quarters, years out there. And if you do ask your brokers, you can get prices, bespoke prices beyond these dates as well. So don't be shy to ask your broker and say, I want to buy Cal 26 or I want to sell Cal 26. Not a problem. Most of the time, he's able to find a buyer who might have an opposite position or a seller who might have an opposite position. So this is just a representation and again, just an indication of prices. You need to dig deeper into this, use this to try and get 2 things. Number 1, what is the price at which you're comfortable looking at this? What will be your potential indicative price? Secondly, what kind of trend are we looking at? Is the market going up, going down? And how is it being reflected in the physical space as well? You need to start correlating this as well with your physical exposure. Right. Now, once we've done all this, we are now able to define what an FFA actually is. We've done all the elements of a swap. We've ticked all the boxes. Let me now define FFAs. This is something that you need to write in an exam, so look at it that way. An agreement between the buyer and the seller to respectively buy and sell the agreed quantity of freight at a mutually agreed and fixed price, element number 1, with the benchmark being Baltic exchange route, number 2, on a specific date or a time period, number 3. That's essentially how a FFA is defined. But if I'd given you this definition right at the beginning, you would not have appreciated the elements which go into this definition, which is why I had to take you through the swap elements in order to get the FFA defined. Now that you have the clear definition of an FFA, you understand that it is nothing but just a swap of an underlying asset, which is freight. So now we can actually talk about what do we actually trade and how do we trade FFAs, right? So far, clear? Understood how the swap works, how the FFA scenario works, how these market reports that come to you every day, can you demystify them? Hopefully you can, right? Now let's look at how the trading gets done. So I'll take 3 different scenarios and run you through how those scenarios work out in terms of FFAs and physical contracts. Because remember, physical contracts and FFA contracts run parallel to each other. It's not one or the other. It is one and the other. Both of them are running parallel to each other. So the first scenario is a ship owner scenario. What does he do with regard to trading FFAs? Second scenario is a cargo owner scenario, which is usually the opposite of a ship owner scenario. And finally, an operator scenario, which is neither an owner nor a cargo owner. He's actually both. So he has a slightly different way of looking at it. And I'll try and take very practical examples when I look at these 3 scenarios. So let's start with the ship owner scenario. This is what the elements look like. As an example, you have a new building, Panamax, being delivered to the ship owner in January 2025. Okay, ship coming next year. Looks like a very good market. Everybody is quite happy about it. Ship is coming next year. Naturally, the owner is long on freight. Long because he has a ship that is already as a position sitting with him from next year, January and beyond. And he has actually wants to hedge his earnings or lock his earnings for 2025 today. Today. He wants to lock in the numbers today. But it is very, very challenging to lock it in today. So he has 2 options available to him. The first option is he goes in the market and says, it's April now, everybody is attending Singapore Maritime Week. Nobody is really able to fix his ship for him, but he wants to do it today. Where does he find that physical charterer to take on that ship for 1 year? Delivery Jan 2025. He may get somebody. He may be happy with the price. He may not be happy with the price. But he also has the second option, which is he can sell because he's long position of the ship. He can sell Cal 25 FFA for Panamaxes. The whole of calendar 25, he can sell in the market. That's how he looks at his position. I have a ship. I'm long on the freight. Now I have to sell to hedge my exposure. So how does that hedge work? So the ship is the physical exposure, which you can see on the top. And the FFA is represented by the dollar sign, right? So today, on 12th of April, he has decided to basically sell 365 days of Panamax Index Cal 25 at $13,250. That's the price he's getting in the market. The bid-offer spread, he negotiated his best, and he managed to get $13,250 as a sale price. So he has sold the 365 days, the whole of calendar 2025. Come Jan 2025, the vessel gets delivered. At the end of the Jan 2025, on 31st of January, the ship earns $12,000 in the spot market. Why does it earn $12,000? All the world wants to have a 2025 built ship. So all the December deliveries got shifted to January deliveries, right? Nobody wants a 1-year-old ship after 1 month. So everybody has pushed it down. So $12,000 market, it went down to 12,000. On 31st of January, the BPI average for the whole of January, average for all the 31 days is 12,150. That's the scenario in January 2025 end. So his physical earnings are the 12,000 he earned in the market, and then he made a profit of $1,100 per day from the FFAs. Because remember, he sold it at $13,250. Now he's buying back January for the whole month with $1,100 profit. Which means that his earnings for January is the physical earnings of 12,000 in the market plus the profit on the FFAs of 1,100, he makes $13,100. Why is there a gap? Because there will always be a gap. You can never get it to the last dollar ever. You will always have an up and down scenario. So let's take an up scenario now. On 28th of February, he realized that his vessel has earned $15,000 in February. The market has started pushing up. You know, Chinese New Year is over. Everybody is jumping up in joy. So $15,000 is what you're earning. The average for the BPI is 14,750. The index hasn't really caught up in the big way. But basically, your earnings are now the $15,000 in the physical market and the loss on the FFAs because you sold the BPI at 13,250. You now have buying back the 28 days in February at 14,750 is $1,500 per day. So your Feb earnings are now 13,500. What was he happy with at the beginning of the year or in April this year? Today, he was happy with 13,250. In February, he made 13,500. He should be happy. That's how the hedge is working. And by the way, this will keep going on till the end of the year, the whole of December. It will keep settling month by month by month by month. That is the whole idea, that you're going to get your money as the hedge keeps settling, unless you neutralize it by buying back at that point in between the hedge, right? So this is a simple ship owner scenario. Very simple. You start with the intention to, you're happy with a number, you start selling it at the number, and then you start seeing how settlement happens all through the year. And you keep getting your average. FFA profit and loss augments the physical earnings, and obviously you're supposed to make the money that you're expected to make. Not to the last dollar, but at least close by at the end of the day. Right. The cargo owner scenario is opposite. Cargo owner has got basically a single cargo to be shipped in March 2025, Cape size from Brazil to China. And the steel mill, which wants to ship this cargo, is worried that the market will go up from now up until March 2025. So he wants to really hedge his position today, wants to lock the freight in today. So what are his options? Try and find a Cape size owner, Empros or whoever else, to try and fix that cargo for March 2025. He may or may not find somebody who can do that. Option, he buys FFAs. For a route C3, which is Brazil-China, if the route is liquid enough, and we'll come to liquidity in a minute, liquidity will mean that you can actually buy a specific route for that specific amount of tons that you actually have as your exposure. So there you go, physical and the scenario. Now, 12th April, you bought the 160,000 tons of your cargo exposure at $20 per ton. Why did you buy Feb 2025? Because it is 1 month lagging. Your laycan is 1 month ahead of the index date. If the index date is in February, you're going to load March cargo. Because most of the ships calculate Brazilian loading as ballasting from China, going to Brazil and coming back. So you got to be a little bit smart about what month you want to buy at the end of the day. So he entered the market in February saying, what are the spot ships that can do my cargo? And of course, the market had gone up and he was actually looking at $22 per ton. He covered the cargo at $22 per ton. The minute he covered the cargo, he unwound the hedge of 160,000 tons that he had actually got at $22. He now actually got it at $22.10. So remember, he had bought at $20 the hedge. Now he unwound the hedge by selling it at $22.10. He made a profit of $2.10. But of course, he paid $22 in the physical freight as well. So his net freight turned out to be slightly under $20 of $19.90. He's happy. The ship owner is happy. Everybody's happy. The guy's got $22. He has got a $19.90 freight. Everybody is very, very happy about the whole thing. But the hedge works at the end of the day because it's a route hedge, and that's what makes a difference. So physical freight has got nothing to do with the FFA profit loss. Important. Physical freight has got nothing to do with FFA profit and loss. It's a component of both of them coming together and creating your net number sitting with you. So the other option is you actually do what I showed you buying and selling was a pure vanilla FFA. The other option is you don't buy or sell. You actually only take on a right to buy or sell. Those are called options, freight options, FFA options. So options are financial instruments that allow buyers to hold the right, not the obligation, only the right. Sounds very ideal, right? We would love this in our real life, only have the right to do something but no obligation to do something. It's a fantastic space to be in, but you have to pay a premium for that, and that I'll come to in a minute. So you have an option, right, but not an obligation to go long, which means you can buy something, call option, or you have the ability to go short. That means you have a right to sell something at a particular price on the underlying FFAs. Now, it's similar to an insurance policy where obviously the insured pays a certain amount of money as a premium to buy protection. If something goes wrong, insurance company will pay me, and that is why I'm paying the premium. I'm actually having an option. And of course, it's a very easy space because buyers and sellers both have basically got different reasons to buy and sell options. And this I'm explaining to you why. Because an operator is always looking at certain scenarios where he needs to start looking at options of FFAs. You cannot have an outright buying and selling in some cases. In some cases, you have to have an option that is a right to do something, but not an obligation to do something. Why? Because you don't have the same obligation down the chain. You're not a ship owner, you're not a cargo owner. You're stuck between the two. It's a sandwich situation. How do you manage the sandwich situation? Like this. This comes from SGX, by the way. So this is the scenario. The operator is bidding for a COA for 2025, which will need a Panamax to be hired for 1 year. So one Panamax for 365 days will be employed on that COA contract. The charterers need freight rates valid for 2 weeks. And the market is constantly changing, moving. You're very worried about it. The operator doesn't want to remain exposed on this particular 2-week validity. So what does he do? The option is he actually takes a vessel for delivery 2025, a Panamax, with 2-week subjects. Good luck with that. I've tried that. Even 48-hour subjects are pretty difficult to get, especially when it's a moving market. So 2-week validity, the guy is going to ask for the moon. Not realistic. So what does he do? He buys a call option. He buys an option to go long. He buys an option which gives him the right to buy, but not an obligation to buy. And how does that work? This is how it works. So on 12th of April, you bought the call option at 13,250. Same 13,250 for Cal 25. The minute you buy an option, you must pay a premium to buy the option. SGX has a free option calculator on their website. It's a very complicated formula, but don't worry about it. Look at the website and just try and get the option price from the calculator. Now, he then offers it firm for 2 weeks validity to his charterer. The charterer is very happy to see a 2 weeks validity. On the 28th April, 2 scenarios can happen. One scenario is the deal gets confirmed. He exercises the option. He's very happy. He exercises the option. He has got the hedge at 13,250. Suddenly, he's got position now. He's very much hedged his COA. Exactly the same scenario as ship owner's option that we looked at right at the beginning, ship owner's scenario. The second option is the deal doesn't get confirmed. Then he loses out. He doesn't exercise the option, and all he loses out is the price that he pays for the option. So the premium that he has paid for the option is lost. This is important to understand because not many operators actually play the FFAs from an optional perspective. It is possible to play it in an optional perspective. You just have to decide whether the premium is worth paying for. Certain customers require long validity. You must try and see if you can support them. There must be a premium there. You can actually try and build that into freight relationships, lots of ways of doing it. That's something which is very common. Now, over and above that, there are some other strategies that you can use FFAs for as well. So first is you can actually buy one contract period and sell another contract period in case you see the structure, the actual direction of FFA is changing. The nearby periods are actually valued much lower than what you think the physical market looks like. But you don't want to take a big exposure because you want to be net balanced, which means you sell the forward market and you buy the current market because it's undervalued. You can start making money between the intra-space spread. Then, of course, I used to do this a lot in Clavenes, and I know other owners do it as well. They buy other sizes in order to basically try and work with the hedge. It's like a proxy hedge that we talk about. So if we had post-Panamaxes in Clavenes, they were far closely aligned to Cape indices or Cape markets than Panamax markets. It made no sense for me as a post-Panamax operator to actually start looking at buying Panamaxes to hedge my exposure. It made better sense for me to buy Cape exposure because Cape was much more closely aligned to post-Panamaxes rather than Panamaxes. That is basically selling and relative value trades at the end of the day. And of course, if you really are smart or you really have a trend in terms of how the numbers work, you have very clear idea about where the market is going, you have fundamental understanding about the market and you think that they're mispriced, you just decide to basically buy as speculators. So you are able to basically go ahead and take positions in the market and then either neutralize them or let them go through and make money out of it. A lot of people do that. There are, of course, every shipping company, most of the shipping companies have their own FFA desks. And FFA desks make their own money independent of the physical trading and the hedging that happens. So that's not something unusual. That is quite common. But please understand that this is something which is risky and you need to be very clear. And I can tell you that's where technology, research, market understanding plays a huge role. But it's a risk, no doubt about it, right? So these are some of the strategies that you can look at. Again, I just wanted to also clearly or quickly highlight who are the key players involved in this trade effectively, right? So the first set of people are the buyers and sellers. Quite logical. You need to have buyers and sellers. Then you have a set of FFA brokers. What Kenneth mentioned was IDB. IDB, intradeal brokers are the people who actually talk to the buyers and sellers and fix up the prices over the counter, right? So these are the people who are actually your Clarksons, your Arrow, and a whole bunch of other companies. Then, of course, you have the Baltic Exchange, which actually is involved in producing the indices. And that is very important. Then you have clearing houses, and I'll come to clearing houses in a minute. And then you have clearing members or clearing agents. These people are different from the ship brokers, the brokers who are FFA brokers. FFA brokers are just giving you the deal together. The clearing agents are totally different. Although they may be the same company, but they have a different unit and different entity which clears the futures with SGX or any other clearing exchange. So that means that there are 5 key players involved. And how does that work? So the cleared FFAs are basically a way of ensuring that the chaos gets converted to calm. And that's what they do. You take an FFA position and you can't sleep at night because you wonder what's going to happen tomorrow morning. Will the guy pay, not pay? What will happen? All that they take out of your equation. So everybody, once they register with the clearing house, the counterparty for the clearing house is always the clearing house and the buyer and seller respectively. So they don't really talk to each other after the clearing is done. The clearing house comes as a key intermediary who actually takes on the counterparty risk at the end of the day. Of course, they do it for a premium. They're not going to do it for free. So I'll talk about that as well. So these are some of the advantages. Massively reduced counterparty risk, automatic netting of long and short positions. So if you have one long position in a particular size or a time period, and you have a short position in another time period, the clearing house will see a net position. They will not see actually you pay this much in one side, I will pay you back this much. They take a net position, which is very useful. Single window space for multiple counterparties. You can have multiple counterparties, but you're really discussing only with SGX. Your counterparty is SGX at the end of the day. Mark to market. What does this mean? This is very important, guys. Mark to market means the indices are being produced every day by the Baltic. Based on those indices, the FFA prices are fluctuating every single day, and there is a market being created. When the market closes on that day, the FFA prices based on that day will realize your position value in the market. When your actual value of the positions is up or down, you have to really bring it to the market level, which means either you have to pay to the SGX or you have to get. And that's where margin calls come in. And I'll come to margins in a minute. But most importantly, you can't have a Nick, what is the guy? Nick Leeson situation where you basically can have a very long position or a very short position because you've just taken a bet on the market. Because you actually have a big losing position, any losing position, it will start getting captured very quickly in mark to market when it's clearing house based. Previously, before 2009, when I was with Clavinus for the first 3 years, 2006, 7, and 8, 85% of our trades were over the counter, which means that we never had a mark-to-market position. We actually would only know whether it's going to be paid out or not going to be paid out at the end of the FFA tenure. And then we had Pioneer Futures, and we had huge problems and massive defaults. Everything went topsy-turvy. After that, pretty much everything is cleared today. OTC is a pretty risky business, so you have to be very careful when you do that as well. So once a deal is done, and Kenneth went through this, and I'll go through this again, these 6 steps are very important. So tomorrow morning, if somebody says, okay, I found this interesting, guys, I want to start doing clearing now, I want to actually start buying and selling FFAs. How do you do that? The first step is always to basically do the physical or the FFA deal between buyer and seller. Trader A, trader B, buyer and seller. Replace this with buyer and seller. You're talking to an Arrow or a Clarksons or a Braemar, who is your inter-dealer broker. First step. Then the inter-dealer broker can actually go ahead and start registering it through the SGX Titan over-the-counter system. And of course, that trade has to be cleared by a clearing member. So clearing member will get involved at the next stage. And depending on all these aspects of position limits, margin limits, the price band, he will actually say, I have got your clear transaction done. Now your counterparty is effectively SGX in this case. That is effectively how you can do your transaction. What do you need for that? Those 5 parties that I mentioned. Buyer and seller, FFA brokers, Baltic Exchange, clearing house, and clearing member, and clearing agents, same thing. These 5 people are needed to do any transaction at the end of the day. That is what you need. And these are the steps to do that transaction. Now, as you know, in life, there's no free lunch. So if there's no free lunch, what is the money that you have to pay for this? Biggest challenge is margin calls. And I remember when the market collapsed, we had no clear transactions. So we were very lucky. But the next time the market volatility came to visit us in 2013 and 14, we had all clear transactions and we had huge margin calls in Clavinus. Suddenly monies were being taken out of our bank accounts in millions of dollars, and then suddenly they were coming back in millions of dollars. It's a big challenge. But what are these margin things? I'll not go much in detail, but basically there's a client to member margin. What is a client to member margin? You as a buyer or seller has got an agreement with the clearing member. You are the client and clearing member is the member of the SGX clearing house. They have a margin limit called the initial margin. They set that according to what the member feels comfortable. If the member is comfortable with you as a counterparty, he may set it at 1.1 times the amount involved. But if the guy feels that your risk is a bit high, he might ask for 1.2 times, 1.3 times. That is a client to member discussion. That's nothing to do with SGX at this stage. The SGX comes to maintenance margin. That is the discussion that SGX has minimum amount required to keep the account going with SGX. This is the discussion between the member and the clearing house. So 2 stages. One, you as a buyer seller having a relationship with the clearing member, and the clearing member having a relationship with the clearing house, SGX. So 2 different margins. And then every single day, there's going to be a mark-to-market situation. Your position was at $20,000. Suddenly, it has gone down to $10,000. If it's below margin, they will ask you to put some more money in your account. If it's above, they might refund a certain amount of money back into your account. And this happens every single day, guys. Remember, it happens every single day. So I can tell you the cleared FFAs are great, but they're not for the faint-hearted, because you can see a lot of money going out of your account and coming back into your account, knowing fully well that that money may go away again tomorrow morning. You have to be super careful in terms of how you manage that. Now, of course, the advantage is that you don't build up any major losing positions. You don't have any major debt challenges. But this is an example of how this works. So if you see on day 1, your settlement price, in this case, you started with $70,000 deposit. Your initial margin was set at $66,000. That's the number between the client, that is buyer and seller, and the clearing member, set at $66,000. While the clearing member, smart about it, is keeping some buffer, his margin with SGX is only $60,000. So he's got $6,000 up his sleeve because he's trying to basically make a clearing transaction there. So the first day, settlement price is $150,000. The market has gone up $10,000, which means your $70,000 has now become $80,000. The next day, it goes down to 63. Still no problem, because you're between 60 and 66. The minute you go below 60 to 58, there will be a margin call to bring it all the way back up to 66. This is a very small example, but you're not trading in just one contract most of the time. You can end up having, maximum I've seen, $7.5 million in a day moving out of your bank account to the clearinghouse. It's not a very pretty sight, but it's needed, right? So that's what you really are about. So this is how the margin scenario works. So not for the faint-hearted, for sure. Now, somebody asked me this question during my break as well. What about liquidity? I think Kenneth touched a little bit on liquidity. I asked Kenneth to provide me monthly volumes of FFA lots. And as you can see, Panamaxes have actually been quite, the green line has been quite good in terms of, in some cases, it's actually overtaken the Cape volume, which is the orange one. The brown ones are Supramaxes, which are also quite healthy. The dark brown one is the Supramax, and the light brown one in the bottom is the handy size. So honestly, if you're a handy size ship owner, FFAs are not an option. I know a handy size ship owner based in Denmark. His entire FFA portfolio is Supramax portfolio. He cannot work with handy sizes because there's no liquidity. Now, how do you manage liquidity challenges? So you've got 2 different challenges to look at. First of all, you can do proxy hedging. So we already talked about it. You can buy a proxy hedge for Supramaxes in case you have a handy size exposure. No problem there. But most interestingly, you also have a liquidity challenge for the forward month sometimes. Even if it's a Panamax or a Supramax, you may get more liquidity for next 2 months. But the next year, a year after that, there's no liquidity. Nobody wants to buy and sell because the market is very, very illiquid at that point of time. So how do you do that? You actually start buying your nearby months and start loading up your hedges and start transferring the hedges month by month. Risky, but the only option because you expect that this movement will be in tandem with each other. So you start buying April, May, April, May, April, May in big volumes. And then as April passes, you start into May, June, May, June, May, June, and accordingly start transferring your hedges later as the liquidity builds up. That's the only way that you can actually work with liquidity challenges. Another thing to remember is you may actually have an exposure on a voyage cargo, but that voyage route is totally illiquid. Nobody wants to buy and sell that voyage route. So what do? You convert that voyage rate into a time charter rate. So you take your profit, which is your income minus expenses, and divide it by the duration of the voyage, and you come up with a daily time charter equivalent. And if you can buy or you can hedge your exposure at close to that number, you decide to basically go ahead and buy the TC or time charter FFA. So this is a way of converting your voyage cargoes into a time charter rate, and from time charter rate, you're basically hedging your risk. It's an indirect hedge. It is not a direct hedge. Make no mistakes about it, because you have things like bunker prices and so many other things where you can get stuck in a voyage cargo, right? But this is the closest it can come to in terms of liquidity challenges. If the Capesize voyage rates are hedgeable and somebody wants to basically buy and sell C3, C5, which is, by the way, very liquid, you can get that going. But Panamaxes and Supramaxes, good luck. No chance. First of all, there are no voyage cargoes and on the routes. But more importantly, nobody really is willing to give that kind of FFA hedge. So these are some of the strategies that you need to keep in mind. Right. Now I'll come to a very interesting topic, which is technology and FFAs. So technology for me is never an end in itself. Technology is always a means to an end. It must basically support you to get to a place rather than actually the place itself. It is a means to an end at the end of the day. So I have got Tatya here with me, who is one of the startups which I advise in India, also into geopolitics. You heard the Navigate Commodities person also talk about the geopolitical challenges. But here, I just wanted to explain how this can be used in the FFA space. What do they actually monitor in Tatya? It's a startup based in India, which is also having an office here in Singapore. They actually monitor how much mining is being done, how much port inventory is there, how much production is being done in steel mills, and they also measure emissions in the mines using satellite images. This data is giving you an idea about what kind of demand scenarios can build up. Will there be enough cargoes to satisfy that demand? And obviously, things like berthing delays and other aspects can go on. One of the simplest things that we did in Klaveness was when we saw a berthing delay in Australia for many, many days, we knew that our hedge is already underexposed, which means we had bought a 50-day hedge thinking that this voyage will be done in 50 days. Now I've got 30 days berthing delay. I have to buy another 30 days FFA, because otherwise I will end up losing my market movement, which is going up all the time. So when you get this satellite imagery, you can actually start getting actionable insights, which I am hopefully trying to build maritime scenarios with Tatya, to basically get the shipping companies to start using this as a way of hedging their exposure, because they know information in advance. This is not going to solve the problem. This is going to be something that will help solve the problem. This is not a solution in itself, but it's something which is vital for the solution. If you take the current scenario on the actionable insights, when the Red Sea impact happened, everybody knew that this market is now going to actually go up, because the same voyage which used to take 15 days is now going to take 28 days. Correct? Which means the supply is going to be contracting, which means there is going to be a challenge with regard to the market. So you can buy the market. If you can't find the physical ship, you can at least take an FFA cover if you want to. So buying the market with the Red Sea supply shock, technology is available. Why? Because you can monitor that situation on real-time basis as to how many ships are being attacked by Houthi. Is it easing now? Is it not easing now? So much information is available for you to actually process. The same thing happened with Baltimore Bridge collapse. The minute the Baltimore Bridge collapse happened, the first discussion was, what is going to get impacted when it comes to dry cargo? Coal. Coal is the major export from Baltimore. Who are the major consumers? Technology gives you that information. They are all India and Asian countries. If they can't find the Baltimore coal, where will they buy the coal from? Australia, Indonesia. That means a negative ton-mile impact, sell the market. You can do that, but you have to take a calculated risk. You need to know how the dynamics are working. But technology is telling you how badly is the bridge affected. Satellite images that Tatya is putting out is telling you, is the bridge being repaired at what pace? Is the debris being cleared or not? What is the next stage? All these things are possible because of technology. At the end of the day, you can build scenarios and you can get predictive analytics to build lots of new models. And FFAs can be actually a very good tool because physical ships may be very difficult to manage in a crisis. But FFAs are very easy to buy and sell if you actually feel the positions are changing. The speed at which you can create a position and unwind a position is much faster with FFAs. It's not possible with physical ships. You take a physical ship, you have to negotiate a charter party. You have to talk to the brokers and sit for 2 days and figure a charter party out. After that, you have to operate the ship also. You have to find a cargo for the ship also. FFAs, no need for any such thing. So technology must be used as a way of building strategies where FFAs can be a very important tool at the end of the day. Right. So what works and what doesn't work with FFA is the second last point that I want to try and make. The last point is going to be an interesting summary that you guys can look for. First of all, you got very secure revenue streams and fixed cost structures when you hedge something. You know exactly what's going to come in your bank because your market is telling you exactly what your positions are. You know what your revenue streams are looking at and you secure those revenue streams. It's much simpler than a physical deal, right? It's none of the complications about a master who doesn't speak English and all kinds of challenges which can happen on a physical ship. Hold cleanness, failures, and all the nightmares you can think of. It's also an ability for players to play more avenues in a market where people are not involved. We were not involved in Clavenes in the Cape size market, but we played the Cape size FFAs for our post-Panamaxes. And that means that we had an option to do it only in FFAs. If we had physically tried to take a Cape size in order to hedge our post-Panamax exposure, would have been a disaster because it would have been double whammy. In case of clear trade, minimal counterparty risks. Logical, nothing new about that. And you can actually enter different sizes at different times because if somebody is a customer of yours, let's say Glencore is a customer of yours, and they have been doing business with you on Supramaxes all the time. Now they tell me, oh, I want to do a Panamax COA next year with you. Can you do it? I would think, okay, but I have to hire a Panamax first. No, you need to buy FFAs and give them a freight rate and play the market where you can enter a new market, you can keep customers going, and that's a huge advantage with FFAs. And then you have these optional areas, call option, put option. You can have sophisticated products. You can actually, as I said, give somebody firm for 2 weeks. You can actually build optionality into your discussions, right? So if you're giving somebody an option, you're also buying an option at the same time. You're hedging yourself as you go along. So it's a very interesting space. There's a lot of things that work for FFAs, but some things don't work for FFAs. And this is coming from pure experience, guys, that I talk about. First and foremost, you have a correlation risk. The FFAs are based on the Baltic standard vessel descriptions. Your vessel may not correlate to the Baltic vessel at all. So even though you buy your FFA and sell your FFA, the correlation risk can be so great that your ship can actually lose money in the market while the market is going up for the Baltic index vessel. So you can have a problem where your ship is actually suffering in a market where the market is not suffering, but you have a unique ship that is having a challenge. Secondly, your vessel or cargo is sitting in the Pacific and the basket is going up. The average of all the TC routes is going up. But you're sitting in Pacific and you don't have the ability to get the money which is sufficient to cover your hedge. So you have what is called a route risk or a basin risk. Correlation risk, basin risk. The FFA for each cargo or ship are not matched to the respective physical position. So you may not be able to buy exactly that particular matching. And if you do not have the match, you can run into a risk where you have a price risk as well. Somebody is pricing Brazil to China in a particular way. You might actually have a cargo from Africa to China, very close to Brazil in that sense, but it is not going to be priced in the same way. You might end up losing on the physical cargo. You might end up losing on the FFAs as well, because Brazilian market is not the African market at the same time. This is very important, guys. When I did the digital transformation, I realized that there was a black box in which all the FFAs were being thrown into by the company. So we were quite long in certain ways, we were quite short in certain trades, but there was a net position discussion happening every single day in the office. And I was like, how can you have a net discussion position? Because net position discussion can only happen when you only have one particular commodity or one particular contract buying and selling. Here you're having a mix of so many different contracts. If you cannot link your FFAs to your physical exposure, you will be in a big problem. And that is because you must unwind the hedge when the physical position is covered. If you have sold FFAs against a vessel, the minute you physically fix the vessel in the market, you must unwind the position. Give you an example. If you physically fix your vessel on the 15th day of the month, and you keep that FFA exposure for another 15 days, the market can completely go in the other direction. And you might end up losing more money than the physical profit that you made on the physical position. Unwinding the hedge can only happen when you are connecting the hedge to the physical position. FFAs and physical markets must be connected, and digital transformation should allow you to do that. One of the biggest downsides, margin calls. As I said, not for the faint-hearted. If you take positions, you're going to be ready for some major margin calls if market changes. And of course, clearing comes at a cost. So it's not a free lunch, as I said. There is a clearing cost that a clearing member is going to levy on you. There's going to be a capital allocation cost that you obviously need to take into account as well. So this works, this doesn't work. Do's and don'ts, be very careful. It's not the best or the perfect solution. It is one of the solutions, and you need to be smart about how you do it. Now, I will leave you with this last slide because I want you to take away things that you can change in the way you do it. You must have a structured process. I genuinely believe that. I tell my son all the time that you must have a structured process, and I'm not successful with him, but I hope I'm successful with you guys. So, first, be aware of your risk and position. Make sure you quantify what that position looks like. What does it mean? How many days? What kind of ship? Which particular route? You need to be very clear about what it actually fits in. Secondly, you assess the options available to you in the market. If you can get a physical ship or a physical hedge, it is the best option most of the times. It's only when you cannot get that, or the financial option, the FFA option is so attractive because it's priced very well. It's really looking interesting. Go for it. But be smart about blending both if you can. Third, act. So aware, assess, act, which is managing the risk by taking an equal and opposite position. The action has to be taking an equal and opposite position. Don't try and get greedy by trying to do things which you don't have exposure for. Very common mistake. Monitor. You must monitor your risk and hedge all the time. And finally, unwind the minute your physical position is covered. So this 5-stage process: aware, assess, act, monitor, unwind. This, if you can take away as a step-by-step process of every single position that you have on your physical side and your FFA side, I can tell you that you will enjoy the experience and you will actually make money out of it, or at least you will not lose money. But if you're not careful, it can be a disaster. And I have seen enough disasters to tell you that there are disasters happening all around. And that ends my presentation, guys. Thank you very much for your time.